Hi everyone, this is Anthony again. I'll be walking you through this week's juicy market recap. This week, Australian mining has had strong gains across the board alongside the continued rise in gold prices and the sliding US dollar. Notable gains came from Oklo Resources and Vigor Group, recording 90% and 57% gains respectively. However, the big market mover this week was the Australian aged care industry, which saw impressive gains across the board as the industry rallied in tandem with Labor's election win and their promises of increased investment to improve Australia's dilapidated and underfunded aged care system, having promised an additional $2.5 billion a year, which will be tacked onto the $18 billion allocated to the aged care industry in this year's budget. The most significant of those movements came from Analytica, a smaller firm working in women's health who doubled their stock price this week. The Tabcorp share price was by far and away the worst performer on the ASX this week, with a massive 81% decline. However, this wasn't driven by bad news. The catalyst was a demerger of its lottery and Keno businesses into a separate listed entity, the Lottery Corporation Limited. However, a more meaningful decline came from InvoCare, which saw a 9.1% drop over the past 5 days. This appears to have been driven by a lukewarm response to the funeral company's recent annual general meetings update and UBS's decision to retain its neutral rating but cut its target price to $12.40 on the stock, as they fear that the rising labour cost will offset improving trading conditions. The stock now sits a little under $11. Now for this week's macro figures and market indices. So this week the Dow Jones is up 5.79%, S&P 500 up 2.47%, the Nasdaq up 3.12%, and the ASX 200 up for a second week with 0.5%. The Australian dollar is currently trading at 73 US cents. The cash rate is at 0.35%. Inflation is at 5.1%, and unemployment is currently sitting at 3.9%. Twitter shareholders are suing Elon Musk and Twitter itself as they claim the billionaire manipulated the company's stock price downward in his $44 billion takeover bid for the social media platform. The investors said that the Tesla CEO saved himself $156 million by failing to disclose that he'd purchased more than 5% of Twitter by March 14. They asked to be certified as a class and to be awarded an unspecified amount of punitive and compensatory damages. The timing of Musk's disclosure of his stake has already triggered an investigation by the US Securities Exchange Commission, SEC, the Wall Street Journal reported earlier this month. The SEC requires any investor who buys a stake exceeding 5% of the company to disclose their holdings within 10 days of crossing the threshold. It will be interesting to see if this legal threat forces Musk's hand against his seeming hesitance towards the deal at the $54 per share price, preceding the discovery that a large proportion of Twitter users were indeed bot or inactive accounts. This seems likely as Elon has already pledged an additional $6.5 billion of equity financing to fund his bid for Twitter. Australian tech billionaire Mike Cannon-Brookes has declared he will seek 2 nominees to the board of AGL if he succeeds in blocking the energy giant's controversial plan to spin out its coal-fired power stations into a standalone company. In a letter to the AGL chairman, Peter Botten, on Friday afternoon, the Atlassian co-founder reiterated his unequivocal opposition to the planned breakup of AGL's retail power generation divisions, because he believes it will create 2 smaller entities less able to fund the accelerated shutdowns of its emission-heavy coal-fired power stations in line with necessary global climate action. Ernst & Young have been advised by JP Morgan and Goldman Sachs on a possible listing or sale of its consulting business. An IPO or partial sale would be the biggest shake-up to the global advisory sector since the Enron scandal, which saw the fall of Arthur Andersen almost 20 years ago, and would be the first IPO of a global advisory firm since Accenture listed in 2001. The advice comes due to an increasing regulatory pressure as a result of the conflict arising within Big Four, which provide non-audit services to their audit clients, to the point that this comprises the majority of their business. This is an issue that has been brought to the forefront in the past months, due to a string of audit-related failures, including Ernst & Young clients, Wirecard, and Luckin Coffee.